So, welcome to an off the cuff edition of Nucleus Investment Insights and macro business video that we put together for Christmas, um, largely at my insistence because I've written a piece called Catastrophe Australia 2025, and I really wanted to explore this in a podcast to give people a heads up of some of the risks we see bearing down on Australia and Australian assets, because they're coming not immediately, but in a time frame that suggests you should be thinking about it now, so you're in place if it does happen and are not affected by it or indeed benefit from it. Hence this video.
Now, David, you've made the cardinal error, have you, in terms of not only making a forecast but also time frame? Is that
Well, I'm doing minor actions. I'm doing an off the cuff Christmas video,
right?
your forecast, and I am characterizing it as 2025, but it could equally be 2026.
Yeah.
And in some ways, it appears more likely in 2026. So, take that under advisement.
Yeah. So do you want to give? So I'll tell you. Let me pitch my sort of version about, I guess, how we've been talking about this, and I guess then maybe you can dig into some of the what's changed or where you think the timing's from. Is it big picture wise, Australia generally sort of is leveraged to the world economy. If the world economy is going well, then Australia goes well. But it's overly leveraged to commodities and particularly iron ore. And China looks to be the key going to cop it the most from Trump regime. But it looks like Trump's inheriting a pretty good economy. Looks like heading for a bit of a soft landing. Interest rates are falling gently. And unemployment isn't particularly high, so it's a pretty Goldilocks situation for him to be stepping into. He looks like he's going to run up the credit card pretty hard. So at some point, that'll become unsustainable, but it's probably going to take a while, and it's probably going to take him 6 or 12 months for his policies to even start taking any sort of real world effect anyway. Like, even if he hits the ground running and within 2 or 3 months of getting into the White House, he's got tariffs up and running and a bunch of other things happening. The flow on effects are going to take a while to start start drifting out to the rest of the economy. And so it's really this question about how bad will things get in China and how quickly versus I guess strength you're seeing out of US. Is that broadly, or where am I seeing it differently?
Yeah, that's the broader context of it, most certainly. Uh, so I expect him to get the tariffs out pretty quickly, and they'll probably actually cause pretty swift harm as well. Not necessarily in and of themselves, but for instance, what we're seeing in the steel market at the moment is a lot of front running of the tariffs.
Yeah, I was going to ask that question as well. Yeah, keep going.
So in effect, that's pull forward of demand. And so once the tariffs drop, there's going to be an air pocket on the other side of it. And
that's not just steel. That's everything.
That's everything.
Yeah.
Everything Chinese. So
yeah. And so what I'm wondering is, that usually you have this sort of Christmas rush for goods, and then there's a bit of an air pocket after that, and you get that sort of, there's a lull. And so I guess what I'm wondering is maybe we don't get that lull as people are trying to stock up before tariffs.
I think so. Or it's delayed and then it's twice the size.
Yes. Yeah. Yeah. Exactly. When the tariffs hit, then all of a sudden it's yeah.
So I do think there's embedded sort of shock in what he's doing. But it's not this in normal times. I would just say, okay, well, I think steel is likely to take a hit. Iron ore is likely to take a hit. We'll see some stimulus as offset, but over the year, again, our terms of trade will be down, and but that would be manageable, right? It would mean an income shock to the country. In fact, in some ways, it'd be a benefit because, we've been running, we've had this private sector recession for nearly 2.5 years because of higher interest rates, fighting inflation. And so that would be very deflationary and probably be thoroughly welcome in normal circumstances.
And sorry, let me just put that into perspective as well. So when you say a private sector recession, basically what we're saying is if it wasn't for if it wasn't for sort of NDIS and a lot of government spending, the Australian economy would be in recession now. And it is in a per capita recession because of how many people. Basically, on a per person basis, it's been going backwards for, is it a record length now of time?
Yes, it's the longest stretch since the Great Depression.
Yeah, of negative per person economic stats. It's just that we're bringing in more people than we ever have before, and so that's sort of keeping the whole
So,
tick over.
so a deflationary shock would probably in some ways be welcome. The problem is, in the circumstances that you're describing this time around, is we have rolling energy shocks underway. Now, this is driven by the East Coast gas export cartel, which charges more or less what it likes for our own gas because it's busy sending nearly all of it to China and just leaving us a few scraps. And what that's doing is creating a more enduring inflation impulse in the economy, and is the primary reason why the RBA is refusing to cut. Like, so far, despite headline inflation being very comfortable, back in its range, falling fast, weak wages, as I said, virtual recession for years on end, the RBA is still refusing to cut because we've got this energy shock bubbling away in the background, which is keeping core inflation high. And so the RBA is suppressing households as an offset. So you end up with a kind of acceptable inflationary outcome or inflation outcome. But it's crazy because you have to be in a recession to have an acceptable inflation outcome because you're paying through the nose for your own gas and electricity as a result. Now, there's one more variable to add to that situation that transpires next year, and that is mid next year, LNG imports begin on the east coast of Australia. That is, Squadron Energy will begin its LNG import terminal at Port Kembla, and so it will become possible to import gas into Australia to offset our exports. Or, well,
And it might even be gas from Western Australia to into
Queensland. I mean, we don't know like where it will come from. It's taking coal to Newcastle, and it's crazy. It's a crazy outcome to crazy policy. The issue is that in the context you've described, where China is on the rack, the US dollar is flying because the US economy is strong in the short term, and you will have suddenly introduced gas pricing into Australia that is derived from Asian markets, where gas is priced in US dollars and we'll be paying for it with Australian dollars, with a falling Australian dollar, falling iron ore, troubled China, and rampant US. Now, the problem in this is if those LNG exports actually embed and become the marginal price setter for gas on the East Coast, which they will if they're allowed to go ahead, then you end up with every time your Australian dollar falls, your gas price goes up, your electricity price goes up. So you get an energy shock every time your currency falls. And so mid next year, we'd be in this circumstance of China falling. Normally, the RBA is doing an offset, but it's facing an energy shock, and monetary policy is paralyzed. And as a result, you can't cut rates, and your dollar is your economy is so weak that your dollar keeps falling anyway, pumping in more inflation. And you could almost get into a circumstance where the RBA is forced to hike to protect the currency in what is a classic kind of emerging market scenario.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So I guess the question there though is, one of our biggest import sources is China, is whether they would be deflating their currency faster than what the Australian dollar would fall. Or I guess that's sort of the question about.
It's not relevant because it's all priced in US dollars. I mean, they will be deflating. They will be deflating the currency.
Yeah. So it's this thing we've been going on with recently where it's, well, actually for quite some time now, and largely driven out of China, where the price of your goods is generally falling and deflationary. Sorry, your discretionary goods, so your TVs and computers and your toys and things like that keep falling, but the price of local services is sort of holding up. And I guess that's a sort of similar scenario. So I guess what I'm saying is even if China is deflating its currency fast, most of those goods are, that's just, we're back in the same situation we've been with goods falling and services rising. Yeah, and energy rising. Yeah.
Well, I mean, yes, you will have soft goods inflation. The problem is energy inflates everything. Like if you're talking electricity prices, it just inflates everything. So, for instance, if we had LNG exports suddenly start today, we've got a gas price on the East Coast of about $14 Australian, it would instantly go to $25 or $26. The electricity price would in effect double, and you would have a scale of energy shock equivalent to the Ukraine war if that pricing was sustained over 12 months. And now that would add 2% to the CPI all by itself before you're talking about spillovers into other sectors. So it's immense, and it's more than enough to impact monetary policy. Now, it wouldn't necessarily happen this year because in the forthcoming year, because we have the fiscal firepower to offset it. And we're already doing that. We've already got big energy rebates, both to retailers to stop the wholesale electricity shock getting into retail bills, and through direct cash giveaways to business and households, which has actually lowered some of the energy costs over the last few years because the rebates have been so big. My worry is that in the context that you describe, and this is where we start talking about timing and potentially being at 2026 instead. The problem is that, as China reels from the trade war and iron ore supply continues to come on through Simandou in Africa and other things, that we actually end up with a tumbling iron ore price, which really adds to the federal deficit. At the same time that you're getting an energy shock through your falling currency and paralyzing monetary policy, which then adds to the deficit again. And so you're into a scenario in which the energy inflation that simply won't go away because you attached your energy fuels to the currency paralyzes both monetary and fiscal policy simultaneously. And markets just go, well, bugger you, Australia, and you get capital flight, and the Australian dollar just keeps falling. And you get, in effect, a kind of emerging market external crisis. Now, it sounds dramatic, and in some ways ridiculous. But we are going through this already, right? This is not. I'm just not kind of imagining this. We're already in this crisis. You know, the RBA is refusing to cut because we've got too much energy inflation, and in the next 12 months, we've got a very large deficit coming.
Yeah.
So, you know, the dynamics are already in play, and the currency's falling like a stone. So, a lot of that is the broader context, of course, of China and the US and the tariffs and everything. It's not all about this domestic problem. But, you know, those dynamics are in play. The variables are there, and they're sort of swinging together in a way that, you know, is unsettling for a possible crisis 6, 12, 18 months away. Uh, and so I guess I wanted to make this video because I think investors should be aware that they need to protect themselves from this, and now's the time to do it before it arrives. Because you've got, you know, even if it doesn't arrive, because the dynamics are already in play, you don't want to wait for the Australian dollar to hit 55 cents before you panic and think, I've got to, you know, protect myself either A, from this coming inflation, or B, I need to get offshore because the dollar's going to keep falling, et cetera, et cetera. You know, at the moment, you know, the dollar broke down again last night. It's now in the high 63s, but, you know, down from 70 cents not all that long ago. But this is just the start, I think. You know, we haven't even had tariffs. We haven't had any falls in the yuan.
Yeah. Well, and sort of in a way what you're describing really is saying, okay, we've had this energy, this rolling energy, you know, stuff up from both sides of politics, and there doesn't seem to be, and as you said, you know, the thumbnail is, you know, we're one of the world's biggest exporters, but we're the only one who doesn't put domestic reservation or something like that to keep local prices low. On the East Coast, we do on the West Coast, and lo and behold, prices are low. So I guess where I'm leading to that is it's effectively an extension to say, well, this is going to continue and potentially get worse. And uh and so the question then for investors is saying, yeah, as you said, it sounds ridiculous, but then again, it sounded ridiculous, you know, 10 years ago to say, well, we're gonna paint ourselves into a corner where we're paying some of the highest gas prices in the world despite being one of the biggest gas exporters in the world. And so um and in terms of solutions, the Labor Party seems to be saying, you know, we'll subsidise it and hope for the best, and we won't pick any fights with resources companies because that's what led to the downfall of Kevin Rudd, and so we won't want to do that again. And the Liberal Party is basically saying we'll invest in nuclear power and it should be all right by 2050.
Well, that's most of the circus, but the really big clown at the center of it is that the LNG imports that we're talking about being the center of this crisis are being embraced by policymakers as the solution to the energy crisis.
Yeah, that's right.
Right?
We need our own gas back. We need to.
We'll just import gas, right? And we'll have enough supply.
Okay, so I guess I just wanted to put that into a summary. Is we've had 20 or 30 years now of stuffed up energy policy, and but we've managed to, you know, China really boomed in that interim. World growth's been really good. Yeah, so we've actually managed to make it through without too much of a worry, and also we were fighting that low demand and we had low interest rates for ages, and so we got through with the housing boom. But it seems like if we haven't broken it yet, they're going to try for even more and see whether they can. Yeah, so I guess the export cartel, who basically has everything they want, figures, well, nobody's pushing back yet, so we may as well just keep going and see if we can get some more out of this.
Oh yeah, I mean, they're going to look at this and laugh their heads off because, you know, LNG imports, will bring them on, they'll say, and we'll just ration supply further and ensure that the Asian price becomes the marginal price setter for Australia, which is much higher. So they may cut a few volumes and they'll get a huge price boom out of it. And the further or the more trouble Australia gets in with the falling Australian dollar, the more money they'll make.
Yeah. And part of it is you go, well, if we can take effectively, get it out of the ground for $5, spend another couple of dollars on turning it into liquid, put a markup on that, stick it on a boat, put a markup on that, sail it back in and bring it back out again and get a markup all the way through, despite the fact he's saying you never had to do it in the first place. But doesn't really matter if you get to mark it up the whole way.
I mean, this is where the whole thing may eventually result in some rational outcome. Like, I can't believe that we would buy Queensland LNG, ship it south to New South Wales via an Asian market that prices in US dollars using Australian dollars.
Yep.
Like that would be so explicitly insane that surely it becomes politically untenable at some point.
Yeah.
But I mean, who knows? I thought this was politically untenable 10 years ago. And yet here we are. And you're exactly right. Because of that, the gas cartel will push it as far as it can possibly go. Because we've been such a patsy.
Yep.
So it'll just keep shoving.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
So some other stuff then. So in terms of China, if China goes into effectively a recession, based on and we see quite dramatic falls in the amount of iron ore that's needed. Now, is that going to be? How do you see the RBA looking at this, sort of saying, "Oh, we're looking through the energy side, but in the meantime, maybe we've got Russian gas and Russian oil starting to re-enter Europe, sort of bringing down global prices. China, weak economy, but Australia having its issues on the other end. Well, what's the interplay of those forces? Yeah, so I guess what I'm positing is, so on one side we've got some quite disastrous policies in Australia, but Australia's managed to get lucky a few times. And is the luck going to come from Russia re-enters the world market and starts pumping more gas and more oil back into Europe, as the Ukraine is solved, and part of the deal to solve it is getting that turned back on. Yeah, China heads into some sort of recession and demand there starts to fall off and brings down prices. And so, so is that, are we going to get lucky through the misfortune of others?
Well, the thing about this is that it kills your luck. The luck has always been that the Australian dollar was there and would fall if there was trouble. And, that would provide a great deal of stimulus to the economy. Now, if the Australian dollar falls, it will stop interest rates falling because you'll have an energy shock.
Right.
So, it disrupts the entire cyclical management of the Australian economy.
Yeah.
Now that's if fiscal policy can't intervene with rebates. But even in the circumstance where we've done that, it hasn't worked. The Reserve Bank is refusing to cut rates.
Yeah.
Despite the fact that we've got fiscal support offsetting the energy shock. So, this crisis is already happening. It's just that at the moment, it's a slow-moving train wreck. All I'm surmising is that it could get faster in the right circumstances.
Yeah.
And turn into a full-blown external crisis that that I guess the real last domino in the line here is house prices. Where you have both monetary and fiscal policy paralyzed as the currency falls, pumping in more and more inflation, and your house prices crack right at the wrong moment. We can't cut rates, and your fiscal support is limited. So, you end up with credit rationing, banks that can't really be bailed out, or at least only in a limited sense. And instead of it being a massive deflationary shock, it's an inflationary shock. And so it gets worse and worse. And so, I guess that's why I felt the need to make the video for, MB readers and investors, because they should be aware that this is a real risk, and be preparing accordingly.
Yeah, excellent. And so in terms of preparation, international stocks seems the most likely. I guess what are your thoughts around there?
Well, the reason we have a floating Australian dollar is to soften adjustments, business cycle adjustments. When you get an external shock or an end of cycle event, whatever it is that transpires, the dollar falls, and it helps, deflate the economy externally instead of internally. And I would just recommend to people that they use the same facility for themselves personally. Use the Australian dollar. So any offshore assets would be better than Australian if some of this stuff transpires. And that might be bonds, depending on what the broader circumstances are, or it might be stocks. I mean, that's really a call on what the global cycle's doing. At the moment, I would say, yeah, stocks. But we don't know yet fully how the whole, Trump experiment will play out, and when there'll be a pivot to Europe if it plays out badly. So there are lots of options in terms of how to play it. But your best friend here is the Australian dollar, because if this crisis actually if these dynamics turn into crisis, then the Australian dollar is going to make you money. What,
Yeah.
while Australian assets devalue versus offshore assets.
Yeah, and the falling Aussie, and the worse it gets locally in terms of that falling Aussie dollar turning into higher energy prices, turning into RVA stuck, then the better you're going to be off if you've got a significant amount of your assets invested internationally.
Correct. So, people can use that any way they like, and of course, they can rely on some of our services or products if they'd like. And it's certainly something that we're bearing in mind in terms of our own allocations. So, we're offering protection.
Yeah, absolutely. So a couple of different ways you can do it. There's we've obviously got our core international fund where we're picking the stocks, and at the moment we're largely got a fair bit of AI in that, weight loss drugs, a lot of sort of electricity transition type companies, a lot of the service companies that sort of across those, and robotics, and starting to pick up a few renewable energy stocks just on because they're so beaten down, and we actually sort of like the we like the outlook. So there's some stocks that are down sort of 60-70% in that sector, and actually, but earnings are actually starting to pick up. So that's sort of the core international, or you can just take our global leaders, which is just the largest stocks globally. So you pick up the top 40, top 75 stocks, whichever one you like, and you can then sort of put various tilts around those. So you can take out extra, say extra cybersecurity, or extra the big sort of the big tech stocks, Or you can just take out some US dollar exposure within that. And we've got some, a couple of different products where you can just sort of take some extra US dollar on as within those. And then for anyone invested in any of our tactical funds, that's effectively what we're doing within those is we're buying various levels of each of those assets and looking to protect people's investments by using lots of international ourselves. Yeah. Excellent. Anything else, Dave, you want to mention?
Just a Merry Christmas to everyone. This may not happen, 2025, 2026, I don't know, but the benefit of thinking in these terms is, as I say, the dynamics for it are already in play. And so you benefit from positioning for it now. And if it turns into a crisis, well, it's actually turned into a massive opportunity for you as those dynamics, blow off.
Excellent. Thanks. We'll speak about at the next one. Okay. Nucleus Wealth, personalized portfolios for engaged investors.